Welcome to This Explainer, where we're unpacking the complex investment case for China Shenhua Energy. We are looking at a state-owned giant that is absolutely dominating the market right now. To put their scale into perspective, they move enough coal to power entire nations. Now, if you follow the energy sector, you already know this name. But today, we're going to look under the hood to see exactly how their machinery operates, and more importantly, what it all means for the market. Real quick, here is our roadmap for today. 1. Meet the coal giant. 2. The mega asset injection. 3. The financial trade-off. 4. Dividends and valuations. And finally, 5. Risks and final verdict.
Let's get right into it with Section 1. Meet the coal giant, a state-owned energy powerhouse.
So let's look at what makes China Shenhua, ticker 60188 on the Shanghai Exchange, so much more than just a standard coal producer. Analysts often call them the FedEx of Chinese coal, but with power generation attached. And honestly, that hits the nail on the head. They don't just pull coal out of the ground. They operate this massive vertically integrated moat. We're talking about a tightly linked network of mines, their own railways, their own ports, and their own power plants. It lets them control the entire supply chain from start to finish with just incredible efficiency.
And you know, the market has definitely taken notice. This operational dominance has driven the stock up 11% in just the last 90 days alone. That momentum is largely being fueled by rising global coal prices for sure, but there's also a ton of excitement over a major strategic move the company just made. Which brings us to Section 2, the mega asset injection, a transformational move.
This is the real catalyst for Shenhua's recent growth story, a completely transformational move finalized in early 2026. Shenhua successfully closed a monumental 133.6 billion yuan asset injection straight from its parent company. An investment of this magnitude fundamentally shifts their global scale. You know, this isn't just some minor acquisition. It is a massive transfer of operational power that shifts the company from a mature, stable player into a genuine, volume-driven growth story.
Let's look at what that massive capital injection actually secured. We're talking 12 major new mines and their supporting power assets. This move drastically increased their total coal reserves by 65% and bumped up their production capacity by 57%. So the absolutely crucial takeaway here for your portfolio is this: volume covers margin. Even if global coal prices soften a bit, Shenhua now has significantly more tons of coal to sell. That gives them the sheer scale needed to absorb operating costs.
And the sentiment on the street really reflects this massive shift. Analysts at CITIC Securities noted that this acquisition is the final piece of the puzzle for Shenhua's absolute dominance in the Yellow River Basin. And what's fantastic for the company here is that this carries very, very low integration risk. Why? Well, because Shenhua was actually already managing these specific assets operationally for their parent company. They already know the machinery, they know the staff, and they know the logistics.
Moving on to Section 3, the financial trade-off. Q1 2026 profit squeeze. Okay, so despite this incredible leap in scale, we actually have a fascinating mystery of divergence in their Q1 2026 financials. While top-line revenue grew solidly, up 1.2% year-over-year to 70.4 billion yuan, net profit actually squeezed down by over 11% to 11.9 billion. So we've got rising revenues, but shrinking profits. What gives? Well, the profit squeeze basically boils down to two key factors. First, we saw lower realized coal prices, which softened about 5 to 7% from last year's absolute peak. Second, and this is highly important, there was a shift in their sales mix. Recently, they've been selling more purchase coal, which naturally carries a lower margin, rather than relying solely on their high-margin self-mined inventory. But remember that vertically integrated moat we talked about just a minute ago? Well, the brilliance of their integrated model really shone through here. Because while coal margins took a hit, their power generation segment basically saved the quarter. Profits from power generation rose by nearly 10%, partially offsetting the weakness in the coal market. When coal falls, their power margins improve. It's just a fantastic built-in hedge.
Let's look at Section 4, Dividends and Valuations, the Investor Appeal. So with this mixed financial picture of high revenue but squeezed profits, how exactly is the broader market valuing this newly expanded energy giant? Well, currently the stock trades at a PE ratio of around 18x and a price-to-book ratio of roughly 2x. This represents a premium compared to its own 5-year average. That clearly tells us the market has already priced in a highly successful asset integration. The good news is, for the most part, already baked into the stock price. But the real magnet for investors here isn't just capital appreciation, it's income.
And this is strongly underscored by management's recent commitment. They've guaranteed a massive 65% minimum dividend payout ratio for the next 3 years. That means for every dollar of profit they make, at least 65 cents is going straight back into shareholders' pockets.
This creates an incredibly powerful defensive cushion. For yield-hungry investors, especially in shifting rate environments, this offers a trailing yield of roughly 4.4%, and the company just approved a final dividend of 1.031 per share, which is payable exactly today, August 26, 2026. It basically acts like a government-backed coupon that pays you simply to hold the stock.
Factoring in this defensive income strategy, the analyst community remains quite bullish. Across 13 different analysts covering the stock, the average price target sits at 49.44 yuan. From current trading levels, that implies roughly an 11.5% upside, showing that even after the recent run-up, the street still definitely sees room for your capital to grow. Finally, Section 5, Risks and Final Verdict, a balanced perspective. Now, before finalizing any portfolio strategy based on this data, we have to objectively look at the downside. There are 3 critical risks you can't ignore. First, policy intervention. The government can absolutely set price caps on coal to control national inflation. If the broader economy slows, authorities might pressure Shenhua to lower prices, directly capping their revenue. Second, earnings sensitivity. Yes, the new mines add incredible volume, but they also bring strict environmental and safety compliance costs that could easily eat into those tight margins. And third, no growth premium. The stock is up 31% year over year. A lot of this integration upside is already priced in, meaning if there are any delays or stumbles, you can expect some immediate downside volatility. So based on the source material, our final verdict really splits depending entirely on your strategy. This is very much a show-me story right now. If you're building an income portfolio, this is an overweight core holding. The strategy is to buy on dips and get paid that 4.4% yield while you wait for the integration to fully bear fruit. But for pure growth investors, you should absolutely wait for a pullback. The current premium leaves very little room for operational error. Ultimately, the 133.6 billion yuan asset injection gives Shenhua immense market-controlling scale. But looking at the tight margins and the premium valuation, you have to ask yourself one final question. If the integration stumbles, or if government price caps kick in, is that guaranteed dividend enough to cushion your portfolio? Thanks so much for joining this explainer, and I hope this deep dive helps you navigate your own research into the energy sector. Catch you next time.